Welcome to the All Financial Hour podcast with Steve All.
Our good old friends at the Fed, they say they want inflation back down to 2%, so it's not interested in cutting rates just quite yet. So what are the long-term effects of higher rates? Well, here is Brent Schutte of Northwestern Mutual. Here he is on CNBC.
I don't think the Fed's going to be able to cut rates, and the longer that rates remain elevated, the more they work their way into the economy. And we should all remember that on average, it takes 10 quarters for interest rates to impact the economy, at least in the prior times the Fed has hiked, and we're only 9 quarters into this. I don't think we're going to get out of this without a recession. I still think one is likely in the future because I don't think inflation breaks without one.
Okay, so if a recession does happen, Steve, do you see a significant pullback in the market?
And that's what I love about our country. Economists all over the place. You can read the exact same newspaper, and one guy says interest rates are going up and we're going to have a depression, and the next guy says you're going down and everything's going to be wonderful. So everybody's got a different opinion on how this is going to work itself out. Are we going to see a recession? I'm not sure. My crystal ball's broke. I'll just go with that route. But my idea around it of it is are you prepared for whatever happens in the market right now? Because I always get that question, Steve, should I sell right now? And then the next person comes along and says, should I buy right now or should I hold? So buy, sell, and hold are the 3 major decisions that people really want information about when they talk about investing in the market. And that's when I come to it and I say market timing basically doesn't work. It's very difficult to say, I'm going to sell everything today and the market drops tomorrow. Mm-hmm. Or the market's falling and I'm going to buy everything on the very last day that it happens. I think that's almost impossible to do. And that's what I love about Brad Jenkins and Market Guard. It's methodical, mathematical, non-emotional, formulaic that he puts his models together that tell us those things about should we buy, should we hold, or should we sell. Takes the emotions out of it because I think the emotions cause most of the problems for people when it comes to investing. I had a guy call the radio show. He said, I went to cash in 2007. Market dropped in 2009 and I felt absolutely fantastic. He said, people are standing around the water cooler, their 401ks, it dropped by 40 to 50%, and I felt really good. He said, Steve, I'm still sitting in cash today. That was almost 10 years later in 2019. So he missed the almost entire time the market was in an upward swing because he was afraid that if he got back in, it would be the day the market went the other direction. And that's what I'm saying about market timing. It just basically doesn't work. Get a good plan, be there over time. We've got the availability to set you up in what we call static models that basically stay the same. We've got defensive or tactical models. So whatever your risk reward is, we've got the availability to help you there with the invested assets. So if you're asking yourself that question around, is it time to buy? Is it time to sell? Or is it time just to hold on? Call now. Ask about Market Guard. Let us do a risk reward analysis on your portfolio and see what we could bring to it. Because the goal for me and my clients, I want the best return I can possibly get with the least amount of risk possible. Call now. Ask about Market Guard.
Steve, when I come in for this risk-reward analysis, do I need to bring all this paperwork with me? What's that first meeting like?
What we like on that first meeting, we're going to sit down. We're going to want to know what your wishes, hopes, and dreams are. We do have a data collection form. We do need to, if we're going to do a risk-reward analysis, we will need copies of statements. Why? I need to know what your current holdings are, so that I can find out how much risk you're taking to get the return that you're actually getting. And we're going to run it through a Morningstar report. It's not going to be the opinion of Steve All or the All Financial Group. It's going to be Morningstar around your current holdings. How risky are you getting? And how much return are you getting for the risk that you're taking? I look at tax returns because that's one of the big questions that most people have. What about taxes? So we're going to look at those things. But the big thing is, what are your wishes, hopes, and dreams? What do you want out of retirement? And then it's our job to look at your stuff and say, are you pointed in the right direction? And if not, how might we guide you in a little different direction?
There's an article that recently asked, why does an annuity make sense? It says, while annuities aren't right for everybody, you should consider them if you fall into these 3 categories. Number 1, your spending is high relative to your assets that you've saved. Basically, if you need more income. Number 2, you want income from guaranteed sources. rather than risky sources. Makes sense. Number 3, the idea of guaranteed income. Things like annuities, Social Security, even pensions offers peace of mind. So, Steve, doesn't that describe most of what, you talk to people about?
I think Mel puts it best. What are the 3 most important things when it comes to retirement? Income, income, and income.
That's
and
right.
what did you just talk about?
Income.
That my, quote, spending, my cost of living, what that normal lifestyle is higher than my current fixed incomes, Social Security, annuities, or pensions. So I've got a gap in that direction. Well, there's different ways that you can fill that gap. You can fill that gap and say, we're just going to take money out of the portfolio. Mm-hmm. We can build stock portfolios. We can build bond portfolios. Or, as it's stated from here, you could use an annuity that gives you guaranteed income. That guarantee is from the insurance company that you're looking at. So those are the main things that we look about for annuities. Is there a gap? So that is a part. Being a holistic office, we do both. I can protect your assets without an annuity, or I can protect your assets with an annuity. I can create income by buying stocks or bond portfolios, dividend stocks, or I can use an annuity. So I can do whatever you are more comfortable with, because I don't want to have just a one-trick pony. You come in, I got one thing to do with you. I want to build a plan, and then we're going to look at that plan and say, how do we fill it in? But I think one of the things that people miss when they talk about annuities is protected growth. Remember, the fixed indexed annuity is not invested in the market. So therefore, your money's not at risk. Mm-hmm. They usually don't guarantee you any return in a positive direction because of the fact that they're going to use the money to buy an option on an index in the market. If that index goes up, that money's your money. They lock in different time frames for different annuities. So that's when we look at it. If I need the income ones are great. If I just look at it and say, I would like to protect a portion of my portfolio, I really don't want to buy an income rider. Those are expensive. Mm-hmm. I just want the protected growth on the product. So depending on what you're looking for, one, if you've got an annuity that has an income rider on it and you haven't turned it on yet, give me a call. Let us do an annuity x-ray on that. Because in a lot of cases, because of the fact the interest rates are higher today than there was 4 or 5 years ago, we might be able to get you a better income for that exact same amount of money. Now, you might have a slightly longer surrender charge period if that happens. But if you're turning on a lifetime income, that's not a big problem. So that's one thing that could be done. If you're looking at that lump sum versus a pension option that you have, lump sums aren't as big as they were 4 years ago. Why? Because interest rates are higher. Mm-hmm. They can buy that income for a little bit less. So if you're looking for that guaranteed income that you cannot outlive, it would cost less to do it today. So it depends on what you're looking for in your life. Are you looking for income? If you are, it's one of the best places that you can possibly get it. If you just want protected growth, you want a portion of your portfolio that cannot go down due to market volatility, give me a call. Ask about the annuities. Ask about the annuity x-ray if you already have one, and just ask about fixed index annuities if you want more information on annuities.
The Biden administration is proposing new taxes on the wealthiest Americans. And if you think you'll be spared, consider this from a TikTok contributor who goes by the name of the Older Millennial. Listen to this.
The original income tax was the wealthiest 1% of Americans had to pay a 1% tax on their income. And of course, it passed easily. Everybody was in favor of it. Even most of the 1% didn't oppose it. But now the average American pays anywhere from 27 to 50% of their income in taxes. Guys, there has never been a tax that has been instituted by the government on the wealthiest 1% that has not grown to encompass everyone in America. Because that's the hard part for the government, passing a new tax. But once they get the American people to agree to that tax, well, then they have the authority to just raise it as time goes on.
Yikes. Okay, so let me take all that in here. I guess bottom line, this is just making the case to have an effective tax plan before and, of course, during retirement, right?
Yeah, I mean, we start to look at it. When we bought into the 401k in the late 70s, because that's all the longer it's been around, what'd they say? We're going to put your money in this. We're going to give you a tax deduction for it now. We're going to let it grow tax deferred. When you retire, you're going to take that money out. It's going to be taxed as ordinary income. But when you hit that point, you're going to be in a lower tax bracket. Mm-hmm. That was kind of the promise that was made at that time. And they also said you can stretch it when you give it to your kids. They get to stretch it over their lifetime if you don't use it. So it's a good estate planning tool that was used for that also. Well, a lot of those things are not true today because of what I call legislative risk. As it was just stated, nobody has a problem with taxing the rich as long as they're not considered rich.
Yeah, you're right.
I have no problems. People have no problems raising taxes on other people. They just don't want it to be done with that. Mm-hmm. And I have looked at it to the point, if I could break down most of our clients and most of the people that come into our office, they don't say it exactly this way, but there are three things that they're all interested in. One, they all want to increase their net worth. Two, they would like more control of their assets. Three, they would like to pay less taxes. And I look at it to the point where having too much money in your IRAs and 401ks can subject you to that legislative risk in the future. Why? Because they've changed the rules on the 401ks and the IRAs. When that promise was made that you could pass it on to your children and they could stretch it over their lifetime, in 2020, in the middle of the pandemic, the Insecure Act was passed. It was actually called the Secure Act, but I call it the Insecure Act. Mm-hmm. They now said that your heirs can only defer that tax for 10 years after you pass. So having too much money in your IRAs and 401ks can subject you and your children to much higher taxes. And people always ask me the question, Steve, what do you mean when I got too much money? People don't realize that the average 401k balance is somewhere between $150,000 to $180,000. That's average. So if you have an extra large 401k balance between $250,000 to $750,000, you're way above average. You might spend those assets down during your lifetime, depending on what your pensions and Social Security and lifestyle are. If you have a double X between $750,000 and $1.5 million, chances are you are not going to spend those assets down during your lifetime. You're going to pass those on to your children. Do you think they, if they have to take it out in a 10-year period, will still be in a lower tax bracket than what you paid it into at?
Probably not.
Probably not. What if you have a triple X? What if you got 1.5 million or above? You will be passing a tax time bomb onto your kids.
Right.
And so people look at it, and I get the same thing all the time. Steve, I wasn't planning on leaving my kids anything anyway. And I looked at it and I say, would you rather give the money to your kids or to the IRS?
Good one.
Are you willing to pay taxes at a rate that you are going to pay? You get to choose that rate, not what they're going to change it to in the future. So I look at it, I believe that tax planning and reducing income taxes in retirement is the best thing you can do for a successful retirement. So if you have more than $500,000 in IRAs and 401ks, give me a call. Let us do that tax analysis. Now, the reason why I used $500,000 for tax analysis is because the models that we use and the methods that we look at make a lot more sense if you have more than $500,000. So if you're in that category, give us a call. Ask for that tax analysis. Let's see what we can do to help you with taxes in your retirement.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.